right, everybody. Well, thanks a lot for joining me on this Wednesday afternoon market recap. Before we continue, I just wanted to say, if you haven't listened to the previous video that I put out as at Monday, I'd encourage you to do so, because really in that video, we spoke about what we thought the route was going to be that the market was going to take after this candlestick just here. We spoke about two different potential pathways, one of which being that cascading waterfall to the downside. However, what we most commonly agreed on was that we were going to see the back test of this, or at least going back to Friday's candlestick of last week, this outside day engulfing candlestick pattern. Now, essentially what's happened is on Tuesday and Wednesday, we have seen, right, that snapback, knee-jerk reaction to the upside. You can see this is Tuesday's candlestick here. As I sit down and record on this Wednesday, we have about 1 hour left in today's session. So this candlestick here, it is still subject, pardon me, to change. However, as I sit down, the markets themselves, generally across all three, on average, they are up 0.3%. The reason for this video is because we are now back at this neckline whereby we expect the handbrake to be pulled on the market. I will say, obviously, the Fed is continuing to inject a lot of liquidity into that of the repo market that, pardon me, over time, it is going to help the equity market itself rise. However, there is this short-term phenomenon whereby we see investor psychology, all right, or active market participant sentiment really override, of course, some of the fundamental underpinnings of this market, which continue to be relatively bullish throughout 2020 at this current timestamp. So again, I am well aware of that, the changes, or at least Fed policy regarding the repo market. However, again, in the very short term, what we call sort of the micro level of the market itself, right, the minutiae of the market itself, what we do as technical swing traders, psychology and sentiment, how people are feeling, are really going to weigh on the market more so than the backdrop as to what is happening to really support that of the bull market continuation further into 2020. Now, again, on face value, I understand that people may be starting to recognize a little bit of a pattern here. And again, for a novice trader, they might actually say that this is that of a bear flag. And yes, it takes the setup of a bear flag. However, generally with this type of price scenario, in terms of the movement that we're seeing in price action, be it the candlesticks, it generally, or at least markets in this position, they act a little bit differently. Now, traditionally, if this was an individual stock, and if we hadn't seen the run up since October, or the mid part of October, since we've broken out and been in this bullish trend on the intermediate time frame to what has just marked out of the intermediate top, it would suggest, of course, that we would see a very quick, rather short-term break to the downside. However, in this type of context, we can just linger here indefinitely. We can see some pretty big volatility days. We could see some long day white Morobozu candlesticks followed by very strong reversal candlesticks, whereby what we need to do at this particular time is just map out a general sort of X marks the spot area as to where we expect the markets to slow down and then ultimately roll over. So I'm going to leave this red box, this red rectangular box on my screen at the moment, just to give us a little bit of leeway for potentially even a little bit of a continuational pop on Thursday. But what we're looking for at this particular time up here are very clear reversal signals or hints that the market is setting up a legitimate reversal, which may, or at least it should, set up below this intermediate swing high. But we could, of course, dabble or push our head on up just ever so slightly above this swing high, which would then set up, all right, what we call bearish divergence, or otherwise commonly known as negative divergence as well. Now, again, in that Monday afternoon market recap, we spoke about the slanting double top, the potential knee-jerk reaction to fill the open window, which is what we've done today, or really more so on Tuesday. But again, all right, you're looking for reversal signals in this red rectangular box. As I show you this through the eyes of the oscillators, pay attention to this. The daily stochastics, the daily RSI, the daily MACD are all very firmly bearish. On top of that, when you go out into the weekly chart, it shouldn't be a surprise to anyone that we're very, very stretched on the weekly time frame as well. And generally when you see the stochastics begin to recalibrate below the slow line, or at least the overbought setting here, the RSI push out of overbought territory, which is what it's about to do. It's sitting here at about 75 at the moment. And you get that definitive cross on the MACD, generally you enter into an intermediate correction back into the primary macro bullish trend. So again, this process, right, although we've been speaking about it for say 2 or 3 weeks, or really since the entirety of January, since I've come back from vacation over here, really the name of the game at this particular time is to remain patient. Okay, it's very hard to do. I understand that it can become frustrating, but at the same time, as easily as what the majority of the gains in January were given back in essentially 2 sessions, something like this, but longer term, it is still coming. It hasn't happened yet, but it's going to be a little bit of a battleground up here. And the battle itself, it could take, right? Upwards of a week. It could take upwards of a couple of weeks, in fact. But really what's going to happen is that the market is going to try and tempt you into placing a bunch of bullish trades out of simply frustration of doing nothing. I'm here to really sort of drill into you, hopefully, if you're listening to this video, that the right thing to do, given, of course, the amount of risk up and around this red rectangular box, is what we call the danger zone. Again, the radioactive danger zone in equity markets or the equity prices at the moment, is to do absolutely nothing. In fact, what we have seen is volatility obviously drop back down. This is on the back of course, this bullish bounce. So if you're thinking about it again, it may be a little bit too premature at this point in time. I haven't done this personally yet, but I am looking to execute some trades of this nature when I begin to see reversal signals up and around this box, is to either trade potentially the VXX or the VIX with the dollar sign in front. They're your two options, okay, that could, if you wanted to go long volatility up and around this red rectangular box. But in the meantime, it's best to do simply nothing and watch for the legitimate reversals that should show up around this red rectangular box on my screen. I've recapped, of course, the oscillating indicators at this time. You can see the ADX, it's resetting still. The CCI is doing everything it can to remain above 100. It poked its head down temporarily below that intra-session last week, or at the beginning of this week, we're back above it. However, when you see the ADX turn down, in combination, of course, with the oscillators, okay, turning down, which is what I showed you a couple of moments ago, mixed with, of course, the larger fractal being the weekly fractal, which is more so that of the intermediate time frame, right? Wink, wink, with this intermediate swing high in price action over here. If I can get my cursor sort of illustrative tool to work with me, it generally means that, especially on the weekly time frame, to see those big sell signals beginning to form, that you're in a rocky period of a retracement for the coming or the upcoming weeks, if not a number of months. So again, it's very short term to be looking at this and to say to yourself, well, the S&P 500, it's popped on Tuesday and Wednesday. Yes, you're absolutely correct. We spoke about that actually playing out as soon as this candlestick developed, given right the open window. We said it would act as a magnet. It was our preferred option of the two different pathways. It's done this. Now comes the battle. And the battle, although it seems as though the bulls are back in control of the market, that's exactly how, of course, the majority of market participants are going to be feeling and probably reacting or acting at this point. They're going to say, oh, that was a brief retracement. Now it's time to load up and go long again. Everything is fine at exactly the wrong sort of location on the chart itself. Now that narrative or that story that I've just given you on the S&P 500, it is certainly also applicable to the NASDAQ. The NASDAQ has been the strongest of the three markets. Again, the outside engulfing candlestick going back to Friday last week. We got the gap down on Monday. The video came out talking about the pullback or the bounce back up into the neckline. The battle begins, right? It's already begun as at the second half of Wednesday's session. Again, we understand the injections by the Fed into the repo market, again, for liquidity concerns. It's going to underpin or help underpin this market further into 2020. But overriding this is short-term sentiment. Don't ever forget that. What overrides that is short-term sentiment. That's why, of course, we see these intermediate pullbacks along the way, or at least we don't see a linear advance of a bull market going up in a straight line. You always get these pullbacks along the way. And again, just to refresh your memory, we've had quite a few of them. We've had one since the Q4 2018, a second, a third, a fourth. And this has happened in the space of about 1 year and 3 months, okay? And here we are again, probably to the point upon which we haven't seen the market itself as overextended or as dangerous leading up into the Q4 sort of pullback. I don't think it's going to be as deep and as short-term negative as what we saw in Q4. However, I do believe it's going to be a mix or somewhere between that or during this period here and also the period that we saw in the period of May of 2019 as well. Somewhere in between that, we're looking at these markets to retrace. And in fact, the deeper they go, the better it's going to be if you're looking to actually trade this market long further into 2020 as well. Very quickly, I'll show you the oscillating indicators. You can see that they're crossing on the daily time frame. RSI is going to be the quickest. It's obviously sort of recalibrated very fast based off this bounce. The MACD is trying to cross down. The stochastics is crossing down again on face value. It looks like a bear flag. However, I would be very surprised if we just saw this market capitulate and actually break down out of this bear flag. Generally, what will happen again is it's a sort of a multi-week sort of battle or a struggle around this current area that we're trading at, 9,317. Don't be surprised if you see the markets more or less closing here come next week if we haven't seen that pullback, all right? But it is coming. And again, this is that sort of period whereby the market is testing you, whether you sort of consciously understand it or know it to be true. The market is testing you to try and sort of bring in, of course, the most weakest longs in the market, the last sort of people coming to the end of this sort of intermediate bull party before, of course, we enter into, right, what we propose to be that of a pretty decent correction as well. So I just wanted to update you on that. Following along very closely, the ADX is resetting. The CCI, again, very similar to the S&P 500. It's holding up just above 100 as well. So obviously we've moved into earnings as well. This coming week in Pivot Point Pro, there's going to be, at least the majority of our top 12 listed is going to be free to trade, which is exciting because, again, we've largely sat on our hands. We've looked from afar when it comes to trading the market in 2020. It has been a relatively slow year given, of course, the very quick year, the very profitable year that we had in 2019, especially during the beginning of this melt-up phase. There is going to be a bigger melt-up phase later in 2020. This isn't the one when people hear, or when you hear people talk about the melt-up bubble to produce an equity market peak. A lot of people are beginning to reference this period here. I'm saying that you haven't seen anything yet at this particular time. We have to go through another correction until maybe we see it running up into mid to late 2020. But at this point, you should be firmly occupied, mentally anyway, by still this correction, this pullback, especially when you look at these oscillating indicators on the weekly time frame. Very, very big fractals here. Very rarely do we see markets as overbought and as overextended as this, and generally it leads to very negative things. Mixed, with, of course, those ADX indicators that haven't been this overbought or overstretched in a number of months. It's got all of the textbook signals, technically speaking, that this is going to be the turning point or the pivot somewhere in this general vicinity, much like what I've just drawn on the S&P 500 just here for you. I could actually extend this up a little bit just to make it obviously as ominous as what I can. But this is generally, of course, that location whereby you're going to see that handbrake pulled and then the equity prices or the markets themselves slowly drag down over time. So be wary of that, be conscious of that, and at the same time, try and feel okay about sitting on the sidelines and just watching this market if you're not prepared to take opposite trades, or at least short directional trades on the market indices, which again, I'd really sort of discourage people from doing. All right, there's no guarantees that this is going to stop. However, again, based on this analysis, you can firmly believe that I do believe a reversal is coming. But having said that, you can always go long volatility as well. Those two ticker symbols that I've just put out there for you also. Now, on that note, everyone, I'm going to say farewell to you on this Wednesday afternoon market recap. Be good, be safe, and you'll hear back from me. If not Friday, I'll see you in that pro analysis class for, again, a bunch of individual trade analysis, but also a more comprehensive recap into the 3 US market indices. Also on that note, by the way, I should actually talk about the Russell 2000. You can see it's pulled back, it's continuing to pull back, and it actually hasn't seen the type of bounce that we've seen in these other 3 market equity indices here as well. So again, this is showing you relative weakness compared to that of the NASDAQ in particular. And this is taking more so of a traditional bear flag type of route. This is something that could actually break down and lead the other 3 closely followed market indices on the left-hand side of my screen. So pay attention to the Russell. Again, it's showing the trade marks. You can see the bearishness across the oscillators. If I bring up the ADX as well, if I can push the right key, you can see that that's trying to turn up on the bearish turn down. And also, if you go out to the weekly time frame, again, that's why the chart looks a little bit different. Not to mention, of course, that we have set up that of a secondary lower high at the moment. These now just starting to cross bearish as well, which generally means that we're moving into an intermediate pullback. So again, just to leave you with that information, the Russell 2000 is extremely weak. We're sort of dancing around that 50 exponential moving average period. If we fail to hold this level, and again, this can coincide with the bounce, which will probably produce a lower high relative to where we were earlier in the period of January, which will give us that sloping double top. Here's the neckline just here. The bearish trade, or at least the capitulation, will come when the Russell 2000 breaks below roughly 1,630 points to make up for where this green horizontal line is on my screen at the moment. So again, pay attention, stay focused, but at the same time, feel comfortable doing absolutely nothing and just watching other people make mistakes at this particular time. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Farewell.